Thanks for checking out my sixth presentation on basic accounting and bookkeeping in alignment with the chapters in my book, Accounting 101, Easy Accounting and Bookkeeping for Beginners. This session is about concepts presented in Chapter 5, Elements of the Income Statement, and centers on the typical income statement or profit and loss format reported and published as part of a firm's annual financial statement. The income statement is one of the annual financial statements of a company and is also known as profit and loss statement. It shows the titles and summary total amounts of the major accounting categories of a business's chart of accounts. The titles and the total amounts represent the top levels of a category or hierarchy. A firm's chart of accounts is generally created to accommodate 10 or more subcategories for each main account title shown in the income statement. Categories are shown usually vertically in the order of most significant to least significant, beginning with revenue accounts, cost of goods sold, gross profit, followed by sections showing operating and administrative expenses. The recognition concept in accounting is that revenue is recognized when earned, that is, when the firm has completed its obligation in the transaction. On the other hand, expenses are recognized immediately when incurred by the firm and is related to the principle of conservatism. The relationship between revenues, expenses, and the net profit is summarized as follows. When the firm has a net loss if total expenses, including cost of goods sold, are greater than revenues for the period. However, the firm has net income for the period if total revenues are greater than expenses, including cost of goods sold. The income statement summarizes the operating activities of the organization over a period of time, called the operating cycle of the organization. The general ledger accounts in the firm's chart of accounts for the income statement are temporary or nominal accounts because their cumulative balances are zeroed out at the end of an operating cycle or financial period, so they can start the subsequent financial period with zero balances to record activities for the new operating cycle. The chart of accounts shows the categories, descriptions, and the general ledger account numbers that make up the elements of the income statement, and shows revenue account numbers usually beginning with the number 4 and expense account numbers beginning with the number 5. Revenue is the lifeblood of for-profit firms and the main sources of funds used for generating income and to sustaining business operations toward the goals of the firm. Sales to customers might be for cash or on credit terms, allowing customers time to pay at a later date, such as in 30 to 90 days, and are major sources of revenue for large organizations. A firm might occasionally sell depreciated vehicles, machinery, and equipment, or old and obsolete office equipment, which would be shown as other revenue on the income statement because they're not part of the regular or main sources of income for the firm. Cost of goods sold are the cost of the merchandise inventories that are sold to customers during a specific period. The related costs to acquire the inventories that are sold are expensed and called cost of goods sold for the period. Expenses are resources used up by the organization toward running the business and earning income and to keep the organization going. Cost of goods sold accounts are considered special types of expense accounts. Some popular type of expenses of firms include rent expense, salaries and wages, office expense and supplies, utilities expense, insurance expenses, workers' compensation insurance expense, advertising and promotion expenses, depreciation expenses, and the bad debt expenses. Vehicle, traveling and entertainment expenses. A brief note on employees versus independent contractors. Organizations must distinguish between amounts paid for the services of employees of the firm and amounts paid for services provided by outside individuals and firms called independent contractors. The activities of employees are controlled directly by the human resources guidelines of the firm, while independent contractors are not controlled by the firm but are expected to use their own professional expertise and judgment and methods to perform services to the organization. That's all for now. Thanks for watching this demonstration and have a great day.